Hi guys, hope you're well. Not trading today, so I've decided to put a video together on Bollinger Bands. Real popular tool that people, a lot of traders like to use. Often talked about, but quite often people struggle with Bollinger Bands to try and make them work for any length of time. A lot of that's got to do with applying them to the wrong market to try and trade these bounces from the Bollinger Bands in a trending market and that kind of thing. Obviously, you're going to struggle if you try and apply it into those circumstances. But actually, the most easiest way to trade a Bollinger Bands for me is the breakout, because expecting the market to turn on a dime, obviously there's indications and price action that can help you do that, but just to blatantly trade the touches of a Bollinger Band, for instance, that would be one there, that would be one there, which obviously you'd be in trouble pretty quickly. That's one there, and for all it hasn't worked too bad, it's difficult to understand where to put stops and that kind of thing. The way I think Bollinger Bands are better traded is actually for the breakouts. Oftentimes people say that the tight Bollinger Bands, the contraction of the Bollinger Bands, rather, the breakout from the contraction is a nice trade, and you can see that was the case in this area here. But to be honest with you, you could have entered this trade. If we zoom into this area here, you could have entered this trade here, and perhaps suffered quite a pullback, and you may have even got stopped out there. If you just blatantly traded the break at this point here, but the way I like to look at Bollinger Bands is to understand where prices come from in relation to the break. And what I mean by that is, if we take a look at this breakout here, so this trade here, this entry here, now if you were just blatantly trading the breakout of the Bollinger Bands to the upside, you've got to consider that prices have traded from one side of the band to the other, and the likelihood of getting a continuation higher, or for all you did get a few pips higher before the reversal, diminishes, and it's a really high risk trade, a high risk entry. Likewise, if we take the reverse of this particular setup and we look at this particular break here, this area here, again, look at where prices have travelled from. They've travelled from one end of the Bollinger Bands to the other, and prices poke their head through the low here, and of course they start to reverse pretty quickly. Now, I'm not suggesting anyone in the group would take these breakouts, but people do, and you've just got to consider where prices have come from. If they travel from one side of the range to the other during active market hours, so you're not going to have this contraction of the bands. They're going to be quite wide like they are here. Then you don't want to be the person selling here, and you don't want to be the person buying here. What I like to see is trading near the band, and backing and filling bullish and bearish candles at and around the band themselves, and trading at those points. So if we take a look at this example here, as you can see, before this breakout took place, we had multiple bullish and bearish candles, as you can see that there. So we had a bearish candle, a bullish candle, a bearish candle, a bullish candle, then finally you had the bearish candle that actually broke the low of the Bollinger Band, and then we got this nice continuation move down that pretty much just went in one direction. No pain and no pullbacks there to really sweat over. So yeah, this is the type of thing I personally like to see in Bollinger Bands. Trading near the area, and also I don't like to see multiple candles of the same colour coming into the break. So what I mean by that is if we take a look at this example here of prices coming into the level, you can see that we've had 1, 2, 3, and that's been bullish. That's only just a bearish candle. It's more bullish than bearish, so you've got 1, 2, 3, 4, 5. You've had basically 5 candles in a row before you actually get to the upper Bollinger Band in this example, where you would be looking for an entry somewhere up in here, somewhere in that type of vicinity. Now obviously the trade actually did work out, but what you had to suffer was a bit of a pullback, and of course we never know whether or not the pullback would do this and continue low and stop us out. So it's better to reduce the risk of that and simply do a candle count and say to yourself, you know, is there a pullback likely here? Because we've had this multiple of consecutive candles in a row, the chances are that's exactly what's going to happen. So the entry, really, the best entry would be here. The entry would be this here. So we've had some backing and filling, we've had some bullish and bearish candles, all in the upper section of the Bollinger Band, and so we've had trading in this area, this upper section of the bands, and then we get a break on the first candle. So if you look at the probability curve, if you've had a look at any of the stuff that I've done on probability curves, things like candle counts for expected pullbacks is a really useful tool. For instance, the likelihood of there being another bull candle and for this to break higher after just one bull candle when the previous candle had been negative is high. It's a lot higher than if this had been 4 or 5 consecutive bull candles going into this area, like what we have more or less in this area here. So we've got 1, 2, 3, 4, 5 bull candles in a row. What are the chances of having a 6th? Well, of course they're a lot less than there were after the initial first bull candle, and obviously as you go up the scale it gets less and less likely the continuation. So if we have a second bullish candle in a row or bearish candle in a row, but bullish in this example, the likelihood of having a third candle is diminishing. It's ever diminishing, and getting less likely that you're going to have a continuation and straight away, rather than some type of pullback before you get the move that you're looking for, or indeed you could even have a reversal. And one way to negate that from happening is don't take breaks of Bollinger Bands that have travelled from one side of the range to the other. Don't take breaks that are extreme in nature, that you may have like a very large candle into the area and there's travel from one end of the band to the other. You want this trading at the level before the break, and you don't want consecutive candles into the break. This would be considered a pretty low probability trade. Prices have come from one end of the band to the other. We have had some trading in there, but it's pretty much in one direction. We've got this big large candle into the level, which is a bit of a concern. So that type of thing wouldn't be a particularly good entry. And if we have a look at this here, we've got prices trading from one end to the other. We've got consecutive bull candles at the break, so we've got 1, 2, 3, 4. So what's the likelihood of having a fifth continue up in this area? Well, it's diminishing if we understand how many candles on average it's been since the last retracement. So it could be, if we look at this here, we've had 1, 2, 3, then 2 pullback, we've had 1, then a pullback, 1, then a pullback, 3, then 2 pullbacks, 2 and a pullback, 2 and a pullback, sort of 1 and a small pullback, 2 and a pullback. So if you 4 is an exception, is more than what we're used to seeing in this localized section of price action. So the chances are that this won't break, and if it does, it's likely you are going to suffer some type of retracement potential reversal. So what you really want is you want this type of thing here. So you've got trading negative, bullish, bullish, negative, negative, bullish, break. Now that's an entry. That's the type of entry you would be more interested in. The fact that the bands are contracted as well is an extra bonus, but that's not really what I'd be focusing on. Having said that, it is a bonus, but yeah, it's the fact that you haven't had many candles consecutive. You've had 2 consecutive candles into the break. You've had this negative and positive trading ahead of the break, so the chances of having a 3rd, 4th, 5th candle is pretty good. If this had been just 1 candle, it would be even better, but 2 candles is okay, and this would have been a definite worthwhile Bollinger Band breakout to take. So yeah, just be aware of where price has come from relative to where you're expecting it to go. These types of entries where the price has travelled from one end of a wide band to the other side of the band, these are a really low risk entry, but I wouldn't suggest taking it in the other direction as well, because that poses a whole range of other problems that you've got to try and overcome. I'm not saying that you can't. I'm just saying that personally I prefer to take the breakouts when they make the most sense, and these types of entries make the most sense, where there hasn't been this long this amount of trading from one side of the bands to the other, and you don't have these consecutive 3, 4, 5 candles in a row before the break or at the break. Yes, prices may continue slightly higher as they did in this example. It's a really low likelihood that this thing will continue for any length of time. The likeliest outcome is some type of reversal. So yeah, hope you found that helpful, guys. Take care, all the best.